Hi guys, welcome back to Financial Markets. This time, we will dig deeper into the world of financial markets. We will talk about recent trends in this subject, different types of financial institutions, and the stock market being among the most popular markets. I will summarize these new trends into three: technology, globalization, and derivatives. Technology has been growing exponentially in the past decades. From paper trail to blockchain, our financial statements has been steadily evolving. To note, since the pandemic began, a significant number of our financial transactions are done online without bills and coins. With the advancement of telecommunication, financial markets have been integrating quickly. Though regulatory differences still pose a challenge in this integration, it is not uncommon even for retail investors to invest in different countries. With the internet and some apps, such developments in technology have led to more globalized financial markets. Finally, we have derivatives. Although derivatives have been with us for decades already, their role is getting more and more important. A derivative is a security that derives its value from an underlying asset. A future, as discussed in the previous video, is an example of a derivative. The complexities involved in the use of derivative will not be covered in this video. However, the point that I'll make is that it is used either to manage risk, reduce uncertainty for assets with volatile prices, or on the other hand, it may be used for speculation, taking in more risk to increase potential returns. In volatile markets like the foreign exchange market, where different currencies are involved, their impact is substantial. Now let us proceed to the different types of financial institutions. A financial institution is a company engaged in the business of dealing with financial and monetary transactions, such as deposits, loans, investments, and currency exchange. Arguably, the most popular financial institution is the commercial bank, where savers can deposit their excess funds and borrowers take a loan from. Banks have traditionally been located in buildings. However, nowadays, we can see banks that are purely in electronic form. Investment banks are entities that create capital for businesses and government agencies. Their traditional role is underwriting, where they help businesses create securities, stocks or bonds, buy those securities from the business, and sell them to the ultimate investors. Investment banks earn a spread from buying and selling these securities. That is, they buy at a lower price and sell at a higher price. Financial services corporations are financial institutions that offer a wide range of services to both businesses and consumers, from loans to insurance to investments. Credit unions are associations in which members have a common bond, such as being employed by the same company or being in the same trade or profession. Such members can invest and borrow from the union. In the Philippines, they are usually organized as cooperatives. Pension funds are where workers individually or through their company invest their money to fund their lifestyle after retirement. Meanwhile, life insurance companies are entities where breadwinners set aside some funds so that in the event that they unexpectedly die, their dependents will be compensated for the loss of income. Mutual funds are companies which pull money from savers and use the collected funds to purchase stocks, bonds, and money market securities. They help investors with low capital diversify their investments automatically. Exchange traded funds are like mutual funds, but the fund is traded in the stock exchange. Hedge funds are like mutual funds too. The difference lies in the fact that hedge funds are unregulated and are more suitable for wealthy individuals and institutions. There is a bit of a leeway to take more risk and therefore earn more returns when it comes to hedge funds. Private equity companies like hedge funds purchase the stocks of different companies, but rather than being passive in generating income through dividends and price increases, private equity companies actually manage the companies whose stock they purchase. Now, let's talk about the stock market. The stock market is the most active secondary market. It is highly important for financial managers because stock markets are where stock prices are set, and the stock price is the indicator of shareholder value, one that the financial manager should always monitor. There are at least two kinds of stock market. A physical location exchange is a formal organization with a tangible location, like a building, where auction markets take place. When we say it is an auction market, a seller of a stock is being paired to a buyer when they agree on a price. Both parties have brokers who would aid them in the buy and sell transaction. However, for stocks that are less frequently traded, they are traded on over the counter markets instead. This is a collection of brokers and dealers connected electronically to facilitate exchanges. Because of the low volume of trade here, dealers may be necessary. Hence, these are also called dealers' markets. Dealers buy from those who would like to sell and sell to those who would like to buy. They earn a spread, that is, they buy at a lower bid price and sell at a higher ask price, the difference being the profit of the dealer. Now let us proceed to the types of stock market transactions. Primary market transactions are those between an issuing company, which wants to earn capital by selling their shares, and an investor who wishes to buy the stocks of such company. Thus, the seller is the company issuing the stocks. When an investor of a company wishes to sell to another investor, it is said to take place as a secondary market transaction. Here, the issuing company is no longer involved. Stock exchanges are secondary markets because the buyers and the sellers here are the investors of the company. Again, the issuing company is no longer involved. When it is the first time that the stocks will be traded publicly, no longer limited to the original owners of the company, this is called an initial public offering, IPO. This will sum up our introduction to financial markets. Like this video, subscribe to my channel, and hit the bell notification to be updated for future videos.